Well, hello everyone. The New American Realist is back here. Today I have Greg Crennan. Is that how you pronounce your last name, Greg?
That's correct.
And you are the head consultant at Golden Coast. You are out of California, correct?
That is correct.
Okay. I've been following Greg on Twitter X now for quite some time, and I said it earlier on Twitter that I believe your account is one of the most underrated accounts out there. You have thousands of followers, but I believe it should be in hundreds of thousands based on the charts that you provide. It's just reality. It's what it is. And you talk a lot about the housing markets and the things that are really impacting the working class, things that really matter instead of constantly talking about the debt and everything. We know where that is. You know, everybody knows that this is basically banana republic globally, and it continues on. So I have a couple of charts I'm going to share with our viewers in a little bit, but I just wanted to kind of hear in a few minutes if you can summarize your overall look at the economy, where we are today, especially when it comes to housing. What is going on in the housing market, please?
Great. So a couple of things are going on. First, we know that the dollar, as of right now, according to the inflation reports, are declining at about a 4% a year loss in purchasing power. And when you have your currency losing 4% of its purchasing power, that means that things like real assets like real estate tend to go up. But obviously, a lot of the housing market is determined by the interest rates and what people can afford on a monthly payment. So basically at Golden Coast, we've been basically in a very stagflationary type of environment. And we've had a little bit less of an impact versus, say, like the 70s, where unemployment was rising along with inflation. And I think that just has to do with more of the way that the economy is shaped today, where people have multiple jobs via the gig economy. So you can work extra jobs as an Uber driver, DoorDash, etc., to make up supplemental income that doesn't require any type of previous type of job applications process where someone who wants to work can work. And if you look at people holding multiple jobs, 2+ jobs, is at record highs or close to record highs. So we're having this inflationary problem. And the reason why a lot of people are working multiple jobs or this gig economy job is because their main job isn't paying enough to hold down their bills that they need or pay their bills that they need every single month. So, there are some people who are willing to work multiple jobs to, put food on the table and get a roof, which is, nothing wrong about that. But the way that we're being described through a lot of the main media that the economy is strong, well, we shouldn't really need to be working multiple jobs just to put food on the table. And if you look at like things like people working multiple jobs, rising credit card debt over $1 trillion, you're now starting to see delinquencies rise, especially in credit card debt and auto loan debt. Those delinquencies are rising. Regular delinquencies on mortgages are rising. So, people are strapped for cash as the price of everything is going up drastically. So it's like a hybrid version of the 70s stagflation. We just don't really have the higher unemployment rate that we had back in the 70s. But if you look at things like the GDP, now a lot of people look at the GDP and they say, well, we had a good GDP number. Well, that was also true, but you have to look at the fact that the government during Q3 also printed $1.5 trillion, I think, in that, or $1 trillion in Q3. So a lot of that spending came from government, printing during that quarter, as well as they use the PC. They have the Federal Reserve / government have the PCE deflator index, and because energy prices on a year-over-year basis was so negative, that brought that deflator number down, meaning that actually nominal GDP was 8% in Q3, and their deflator was 3%, and which showed the 5% GDP growth in Q3. But on a nominal basis, it was 8%. And I think a lot of people would probably assume or would agree that inflation seems to be more closer to 8% than the 3 or 4% that were being reported to in the media, basically.
Typical double whatever works in those that make the rules, right? I call them the suits. They make the rules. It's always skewed in the way that looks a little better, whoever's sitting in the White House, correct?
Correct.
Yeah.
Correct.
Yeah,
So yeah,
I
I think it has to do with, there's a lot of manipulation of numbers. I mean, they have so many different inflation gauges now, inflation indexes. There isn't just one. They want to do things like let's remove the food and energy out of it. That's not enough. Let's remove food, energy, and shelter out of it. You hear all the talking heads and main articles. Well, if we remove shelter, inflation was below 2%. Well, obviously we all need to live somewhere, right? So you can't just remove shelter and be like, oh, everything's all fine and dandy, because then if the cost of shelter just keeps on rising and our pay isn't keeping up with that shelter cost thing, we're all going to end up homeless anyway. So, the way that they're trying to exclude things out of these indexes is really, ridiculous in my opinion, because these are the, food, energy, and shelter are the three things that we need to survive. Unless we just want to all, get up some tents and join the Bidenville camps. So,
yes,
which are, I think right before we came on, a report from from HUD, I believe, that homelessness is now at a record high since the data has been being tracked. So, that just shows you that it is a serious problem. And inflation is just really, I think, more out of control than a lot of people that are led to believe through the media.
yeah, I've been following the shadow stats too, and I think personally, I think 8% is a very conservative number because taxes are also not included. And in some places, and it's not just in very blue states where it's everything is, as I'm sure you can vouch for that, being out on West Coast. We understand San Diego weather, 70 degrees and sunny and all that. I get all that, but everything is really, really expensive compared to, let's say, where I'm at. It's why I decided to move away. I used to live in Las Vegas. It wasn't San Diego, but I know what I can get for my money back over there and what I can get where I am, right now. But in not including taxes and looking like state of Indiana, I have a friend that is doing really well for himself. He does a lot of rental units. He's also a stock guy. He's been out there for about 15, 20 years right now. He's doing really well for himself. So his main thing is he's not a gold, silver guy at all. He just kind of like most of the people, like 99.5% of population globally, or should we say not globally, United States.
Right,
We
right.
look at that as silly, but he's more into his hard assets are like, paying cash for these homes that are, let's say, $150,000, $200,000 homes that he would rebuild a little bit. He's got several guys basically on payroll, construction guys, of course, and then he rents them out. And he said to me that this is in Indiana, right? So it's not Illinois, it's not California, it's not New York, right? And he said 50 to 100% is the property taxes that are going up. And he's starting to get slightly worried, I can tell, because of that. Now you paid off your home that you own, and he owns a lot of them. But he's like, when are they going to stop? This can now turn out, because it's his bottom line, of course. His numbers is very sharp guy. This is what I can bring in if I spend this much. You get that, right? If the numbers make sense for someone who does passive income like that, it's a big deal. So taxes not included in the CPI, I think, is the biggest joke out there, including
Well,
rent,
that's
shelter, like
definitely
you said.
huge. But the issue with housing and the so one of the big issues is when the inflation report comes out and looking at things like shelter slash real estate slash a renter, is that a lot of the costs don't, first off, the government decided during the 70s and 80s, when we did have double digit inflation, housing was actually in the CPI report, for those if you don't know, or for those who were watching didn't know. And what happened was the government decided that real estate is no longer considered shelter and that it was considered an investment. So they removed that out of the CPI report, and because housing went up drastically during the 70s and 80s. So when you had housing going up, that was contributing to the CPI numbers being in double digits because the cost of housing was going up. And so they're trying to get inflation under control. So they decided to remove that piece. and they declare that real estate prices is an investment like stocks. So for example, they think real estate is equal to a stock. So because we don't have stocks in the inflation report, right? So they decided to remove housing prices out of that inflation report, and they replaced it in what they call owner's equivalent rent for quote unquote shelter costs. And what they do for that is they really just go around on a survey basis, and they say, hey, Marco, what do you think you can charge your rent for? If you're, how much you can rent your house for versus last year. And if last year was 2,000 and this year was 4,000, well, that's 100% increase. And what happened was, the reason why it lags is because when you had that initial surge in money after the pandemic, you had all these people willing to pay more for housing and more for rent. So the initial increase in inflation, if you look at shelter, that actually didn't go up much because people were just willing to pay more. So now you have, now that we've had this effect basically in the overall economy where people think that they can just get away with price gouging, that shelter increase now has been rising while actually prices of goods have been rising less fast. I won't say decline, they're just not rising as fast because demand is pulling back for those. So, but people in the OER report still think that they can get like a top premium for renting, because I think actually rents are either flat or starting to decline, but the OER in the CPI index is still at like 7%. So there's definitely a huge disconnect from that. So like, that's just a made up number. Like that's not actually what people are charging. That's literally just a made up number that goes into the CPI report. So, there's so much disconnect between reality and what the information that is being fed to the public, basically.
Got it. And then when we tie in I wish I saved this. It might have been from you or someone else that I follow closely, like yourself. They were doing comparison from back in the day, like decades ago, like what would be the median home, right, versus the wages. So just to put this craziness before I go into your chart or charts, if we have enough time to cover it all today, it was about today $40,000 an average income in United States for 25 years and up, right? I think it's a little less than that, but let's just say 40,000 is an average, right? And now an average home in the United States is 400,000. So we're looking at tenfold. And if we're going back to 70s, I believe, or 80s, like I said, I forgot exact date, it was twofold, right, for the wages and then the median home. So the disconnect here is beyond, again, I guess the word ridiculous, I can use it. So I don't know how this is still holding on. This is why I could not wait to have you on here, because
well, I definitely appreciate it. So when it comes to real estate prices, I actually just shared today the Zillow index just announced that housing prices amongst I think 50 of the greater major metropolitan areas in the US are actually down on a month-over-month basis. And I think that pretty much like 48 to around 45 of the major metropolitan areas are still down from the 2022 peak. And if you look at the NAR data, it actually, the median sales price in 22 was like 416 for a home, and now it's at 391. We'll start to see if I'm right that, as this recession starts to play out, that as interest rates are dropping, kind of like an 08 scenario, interest rates were falling before like the bottom fell out. And a lot of people thought that that would reignite the housing market, meaning, reignite housing prices going up. But the reason why rates are falling is because people are worried that the economy is going to get weaker in the future. And so that's why the interest rates, I think part of the reason why interest rates have been falling. And so I think the 30-year mortgage rate right now is below 7%, six, maybe over 6.5. But remember, those are also for people with like excellent credit score, 20% down payment. So like when you see that number come across, that you have to be like top tier candidate for those to get that rate. And a lot of people don't even qualify for that. So, I still think interest rates are around 7% or are higher for people who don't have like the perfect, credit rating, credit score, amount for a down payment. So, and as things start to get weaker, and we're starting to see that continued claims is still at like 1.8 million for unemployment. and that number is up about 40% from last year. So we still have, unemployment may be low, but if unemployment is up from last year, like that's less people that can go out and buy $400,000 houses, basically, especially since they're probably on the lower tier or the middle to lower tier income, middle class Americans, or just on that verge. And it doesn't have to be. I mean, we're seeing Citi right now is on the verge of mass layoffs, so those are going to be high paying management jobs and supervisor jobs, director jobs. So it's not just middle to lower. I mean, we're seeing it in the banking and the financial sector. I think they're leading unemployments this year as far as group categories. So yeah, it really is a financial income level of all aspects. And so if I think that that's going to get worse in the future, even if interest rates come down, that's going to put more pressure on housing, as well as people who are actually we're starting to see this in major bubble regions. The Zillow report did state that Austin housing market is down 19% from their peak. A lot of the Silicon Valley houses, where Silicon Valley employees are one of the top paid employees in America, and they're housing in like San Jose, San Francisco, Oakland, those are down 15 to 19% also. So from their 22 peak, and that's the part of America where most people make the most amount of money, and you're seeing those housing prices go down. And so I'm looking at that as a leading indicator. And because we're always trying to anticipate what's going to happen, or project or forecast what's happening in the future. And kind of like when housing was going up, Austin and Silicon Valley were the leading areas, and where you had other regions like maybe Indiana or Illinois where they weren't going up when those regions were going up. So like, once again, that was like a leading indicator. And now we're having like, markets like Illinois, Indiana, maybe on the Rust Belt, prices are, not going down as much, or maybe slightly rising. But they're not going down like those leading markets. And so I look at those leading markets as leading indicators as far as projecting something going on that could possibly happen in the future.
That makes sense. I remember in 2008, I was in Las Vegas at the time, and Las Vegas, I don't know if you agree on that, would probably be if in that basket as well, or maybe close to it, because Vegas is just, boom and bust too. What I've noticed, just incredible price jumps when things are looking great, and then man, that 2008 when it happened, it was bad. I had a lot of friends that were doing pretty good. I was doing a lot of playing poker full time, and some of the guys that were doing pretty well at the time, and they were looking into 1-bedroom condos, Lake Mead, $500,000-$600,000 in 2008. They dropped to like 200,000. So it was not a haircut. It was like you're basically bald with a couple of hairs sticking out in the back that nobody can even see. It was that bad in Las Vegas. So that's another one. I'm going to see if I can pull up. Go ahead. Well,
I was going to say, it's not just nominal, right? So I think one of the charts you're going to pull up is either the Schiller or the regular median house price adjusted for inflation. And so when you look at if we did happen to have a nominal bust, that doesn't stop inflation from going down. So asset deflation is completely different from real world. And we haven't had like a major real world deflation. And even if you go back during the Great Depression, a lot of people will say, oh, that was because of deflation. Well, no, the dollar from like 1930 to 1941 or 44, when we actually were deemed out of the recession, the dollar lost 45% in purchasing power during that decade. So, it also got chopped in half during that decade. And it's funny because we call the 1970s the stagflation era, but we call that now the stagflation. But at the time, a lot of people called the 70s the Second Great Depression. And so they changed that to what we know as stagflation. But the dollar also lost 50% in purchasing power from 1971 to 1980. So basically, you would need to double the amount of income that you had, or wealth that you had, and that's just to keep up with the reported inflation. Now, back then, they also, those were a better gauge of real inflation than what we're dealing with now, basically.
Got it.
And so the chart that you have pulled up here, if you held on to your house from 2007, based on the adjusted case Schiller here, your housing value from 2007 has barely increased in value compared to inflation. And this is just based on the prices of homes. This doesn't go into like things of like maybe you had to do work, renovations, property taxes going up. Because remember, if your house was worth 500,000 back then, and maybe you can sell it for $1 million now, well, guess what? People are gonna have to pay $1 million or pay property taxes on that million versus at 500,000 when you bought your house, right? So those things all come into the cost of the home, and so those can be definitely headwinds for the real estate. If you look at this next chart, this is from this is the S&P Case-Shiller Price Index, and according to them, housing never even really recovered on an non-inflation basis since 2006, basically.
Wow. Yeah. So what I'm going to do is there is a couple other charts that you sent me. I will put all this on Twitter. You are on Golden Coast, is that correct on Twitter, Greg?
That's correct. That's
okay.
correct.
So I'll put these charts up.
And I just want to say that,
go ahead.
yeah, and the charts that you were just showing, it's important to realize, for example, like the whole real estate thing, because a lot of people, the idea of America is that own real estate, and that is like a generational wealth. So like I own my home, right? And even if it goes up nominally, it doesn't mean like I can now afford a much nicer or bigger house in the future, because that nicer, bigger house in the future is also going to get more expensive. So the only way for me to benefit on the rising value of my house is actually to downsize in the future. So that means if I want to go from a house to maybe a townhome or a condo, well, then that would benefit me in the future, as I can sell my house, hopefully at a higher price than when I would buy a brand new condo or a townhome. Then I would profit. But like me selling my house in the future, that won't up me to a bigger and better house in the future, because that house is going to get more expensive for that, echelon higher on income. So it's not really like a wealth building. It's really only a wealth building if you downsize in the future from your current home, or it's a generational wealth, meaning like your parents pass away, your grandparents pass away, and you inherit a house, and then you can sell it. But other than that, real estate really is a little bit of an illusion, because like I said, it doesn't really benefit you in the future. It only benefits me if I want to downsize, or if it really doesn't help me get more ahead to a bigger and nicer home, that everyone always wants a bigger and nicer home in the future. So
I just love this the way you broke it down, because this is exactly what most common people, basically 90% of America, 90% of the world, is trying to figure out every day. Okay, so my home is, I paid, let's find a number of, let's say 300,000, right? I know for California, you can't even get, the front doorbell for 300,000. I understand that, but let's say $300,000 home, right? And now it's valued at 450. I think that's kind of a fair assessment, right? It's about, let's say 400 or 450,000. Like you said, if I sell this house, it's not like I can buy something the same. I have to go in the area that I may not even like. It can be possibly, actually very likely, not great of a neighborhood that you used to live in, as good, I mean. You might go from 3,500 to 2,500 square feet, which a lot of people can swing it no matter what. We know that, in United States, everybody wants to, for the most part, what I noticed, keep up with the Joneses all the time, and just, having 6 bedrooms and I was on that camp too, until I realized what is really going on. So I just want to kind of, before we finish this, guys, I don't want to take up too much of your time today. I just want to give our viewers a little bit of an idea, and you tell me to finish off what you think about that. When I was in Las Vegas, the home that I had was about 2 times the size that I'm in right now. So we're talking, I forget now, 45, 48, almost 5,000 square foot home. It was a new build, only a couple of years old when I left. It was overlooking the strip. I was on the quarter-acre lot, and it cost me about, right now, when I'm looking at 40 acres, half the size of the house, it was 3 times cheaper. It was almost laughable when I looked at it. So I decided to make a downsize on the home. And overall, people will say, well, your standard of living has changed because you don't have all those fancy nail salons, hair salons. manicures, pedicures, all the fancy restaurants. No, I do not where I'm in. I did not want them, right? And I looked at the standard of living actually improved because of, my children have more freedom. They can run outside the house and there is no street inside for a while. And, we have animals now, livestock, horses, they can just do stuff that usually you go pay somewhere to go look at it. So that's what I've been talking about on my channel before any of this was even in the talks to go into. It's really not your standard of living change for worse and downsizing. It was from the quarter-acre lot to 40 acres, including pasture land, half of it, so you can raise some actual animals there if you wanted that, of course. And that was my view on that. So if you can tell us for the next couple of minutes before we close it off, what are your thoughts on land? That's what I was leading to. Where do you see land properties, meaning like farmhouse type of setups, ranches, that type of a deal, like 10 acres, 5 acres? How is that looking at compared to just average homes where you can barely fit a grill in the back and they're all next to each other? What are your thoughts, like city lifestyle on that?
Yeah, so as far as a couple of things, talking about like the adjustments from, living lavishly to more modest living is definitely something that's very important. And I want to say this is something that some people are starting to realize. I have a friend who had a condo in San Diego, and they bought it for like 800,000. They sold it for $1 million. And now that interest rates have risen, there's no way that unless there was a high income level that they're going to be getting back that $1 million if they were to sell it today. And what he realized is that he can profit a huge amount by selling his condo, and he can actually rent for cheaper per month than to owning that home for $1 million at today's rates. So I actually know a few people who are starting to realize like, well, if I can sell my home for X amount of dollars, where some, other, bag holder will have a high interest rate of 7%, I can then take that money and put that into a 5% bond and double my money in 15 years basically. And then I can also have cash flow. I'm not strapped to property tax increases. Oh, and by the way, rents are based on monthly payments are way cheaper today than it is to own. So like for future new home buyers, that's a very discouraging sign because the math to own versus rent just doesn't work out for most places. And so that's also an issue. And so I think that will contribute to the downturn in real estate as people who are strapped by inflation, who are looking for cash, will say, well, if I can sell my home for X and profit off of it, thinking that whatever my Zillow app tells me how much it is, and interest rates are starting to fall, I'm reading articles like, oh, great, this is great. More people can afford a home. I'm going to now flood the market with supply, thinking that the lower interest rates will bring in buyers. But like we said, unemployment is still up on a year-over-year basis and kind of rising very slowly, but it's rising. And so, that could be a very bad sign for the overall real estate market, as the lower interest rates may actually send a false signal to the market and actually and we're actually seeing the supply and inventory is actually rising this year. I think it's still up on a year-over-year basis. So those lower interest rates may actually hurt the real estate market. As far as owning land directly, like 10 acres, the thing is with that is that now you need the money to upkeep that. Now, if you're trying to, produce food on those acres, I mean, the cost of everything also comes into play. So as much as I love the idea of it, during this inflationary times, because I'm up here in California wine country, and so I have friends who work out in vineyards, and they say the cost to maintain a vineyard have just gone up so drastically that it's cutting into their margins. And because it's also competitive, they can't just raise their prices because they can go to somebody else. So they're right now eating the cost on those margins. And so the issue with inflation and owning acres is, yes, it's a real asset, but unless you plan on producing and being able to keep it going to where that brings you cash flow, it actually may not be such a great idea.
Got it. So the last question in the next few seconds, if you can tell me, I know this is not a life advice coming from you or anything like that. I just want to hear Greg's opinion, when is the real estate crash going to take place, or we're going to continue to inflate? Is it going to be 2024, 2025? Just real quick before we finish.
Sure. So I recently had a debate with a guy from Housing Wire, Logan, and I was saying that the median sales price, which peaked out in 22, I think it has a real possibility of declining by 20%. And so I think based on the last report from NAR, they're at 391 for the median sales price of a home in America, and that's down about 5-6% from the record high in 22. So we're another 15% lower from that price. But if that were to happen, you're definitely seeing, drastic declines definitely in the bubble regions. So I don't think on a median scale you'll see more than a 20% decline. But on the bigger bubble regions, you could definitely see something. And like I said, Austin's already down 19%. So you're definitely going to see some of those downturns in those bubble markets. And the only thing that would be worse is that I think whether you adjust for inflation or not, that real estate, unless you got in at a really low price and a really low interest rate, that you probably will barely break even if you were to hold the property for the next 20 years or so. Because most people don't even hold their house for the full 30 year of their mortgage. So I think the average person before just recently would move every like 15 years from their house, I think somewhere along that line. So in 15 years, maybe housing keeps up with inflation, but just over the past 2 years, based on the charts you were just posting, housing is not keeping up with inflation. So that's when the house goes from an asset to a liability, because your costs to maintain your home go way higher than your income on your monthly cash flow basis.
Well, wow, this is awesome. I cannot wait to upload this. Greg, I thank you for your time. I will upload this today. I will tag you on X, on Twitter, and our viewers can find you on Golden Coast Consultants and on Twitter as well at Golden Coast. I will put all these little links down below, and I am really looking forward to maybe in future in 2024 speaking with you and see where this housing market is going to take us. Thank you so much for your time.
You bet. Thank you.
Thank you.